Welcome back to the What's Your More podcast. I'm your host, Quinton Harris, as we start episode 90. And when I hear that, it just absolutely blows my mind because we are getting very near episode 100, which is a huge deal for us. And we're super grateful for it. I mean, because you've got an amazing audience. You guys rock. All the comments you're putting on our YouTube channels right now, absolutely love them. If you haven't got a chance to check it out, subscribe, please do. You guys are killing it out there. We love the feedback. The one we just did on the DoorDash episode and showing the differential in price points on there and the amount of money that can be saved if you just did a simple carry out or pickup. I love what we're hearing on that from all platforms. And I think what I'm getting is a lot of parents' feedback. As we talked about, those kids between 12 and 18, what does that look like when they're ordering that stuff out? And the feedback has just been incredible. So guys, thank you so much. Episode 100 is just a mega milestone for us. Most podcasts never reach that start, and it really legitimizes the podcast as a whole. And to do it in under a year, that's the other thing. I mean, we're going to be 10 months in, and we're going to get there probably about month 11, right? At 11, we're going to get there. So really excited about that, and look forward as we jump on past those episodes and really getting to that number 100. Big deal, guys. Thank you. And just if you could, just 5-star review the podcast. Please share it with some friends, family. Apple, Spotify, Google, Amazon, all those platforms. I will stop the shameless plug right now, but just excited and just want to say thank you guys. Definitely appreciate it. It's been a fun run so far. I can't wait to see what we do next and bring on more guests. Big shout out to all of our guests and our co-hosts, Daniel Halverson, Alex Stewart, and my producer, Charlie Walker. It's just been pretty amazing so far. And seeing how people are appreciating this. So thank you guys very much. So speaking of that last episode we just did, we were talking about like, how do we help people save, right? I mean, and we showed 80% right out the gate that you can save on food costs if you're using a DoorDash service, which I imagine many of our listeners are just based on the feedback that we've gotten. And so today, I kind of want to talk about the most recent inflationary index that came out. Remember, there's 3 of them. There's the CPI, there's the PPI, and then the PCE. I know that's a lot of acronyms, right? So we're going to focus on the PCE, the personal consumption expenditure. And, by definition, what that is that's just a measure of the prices that people living in the United States or those buying on their behalf pay for goods and services, right? And inside there, we have a regular inflationary called the headline, right? That measures everything. And then the core. And the core strips out food and energy because of the volatility. And that's what the Federal Reserve likes to look at as the core. And then there's a sticky core, right? Or a super core, as you may call it, one of those two. That just means they take housing out of the equation. So now we've got everything in there minus housing, energy, and food. So when we take a look at these things, it's interesting to me because the index went up a little bit, right? I'll just cut to the chase. Index went up a little bit, but nothing to be too alarmed about, if you may. But what was interesting is that, there are some analysts from around the country that have made some commentaries in regards to maybe the Federal Reserve, should take a look at home prices because that's going to make the index, of course, look higher down the road. And I thought that was kind of something to sit back on and go, well, I mean, last time I checked, the home prices weren't included in there. When they come up with housing, the housing component is made up of a rent history and then the owner's equivalent of rent, which we've talked about for years, meaning like, hey, you own a home. I call you and I'm like, hey, how much will you rent your home for? And you go, X amount. Well, that's how they're deriving that. Archaic at best, I do agree. That's how they do it. So when you see an analyst come on or, a consultant come on and say, yeah, they need to consider that housing prices are going up. And then, as the housing component of inflation, that of course it's going to go up. And you're going, that's not how they calculate it. So maybe it was out of commentary. Maybe it was broadcasted incorrectly, but it was definitely not relayed correctly. But inside of that are consumer spending habits, right? And when we look at consumer spending habits, we talked a little bit last 2 episodes about the credit card debt situation, that we've breached $1 trillion. And why is that important? Well, we've had a massive jump over the last 2 years, and credit card debt actually went down during the COVID era and now has come back up post-COVID era, and we're seeing first time in the history we've breached $1 trillion, and 50% of that debt is not being paid on a monthly basis with an average credit card rate of 23%. Now, that's pretty high and bad, by the way, and we know that mixed in with another ingredient, which is going to be the student loan debt that comes due October 1st, over 34 million Americans are going to be impacted by that with an average student loan debt of $353 per loan. We know most people have more than one loans. That's going to apply additional pressure to each household. And, yet the administration right now tells us the economy is good, right? And so the purpose of this episode for me today is to say, hey, listen, there are a lot of things, like, I grew up with my grandfather saying, hey, show me your friends, I'll show you your future. In the circle of five that you hang out with the most, you start to become the sum of those people. Well, fast forward in the social media world, you can say the same thing. Like, if you're constantly surrounding yourself with social media, you start to become a component of that, right? Same thing with the news outlets that you listen to. Same thing with the people you hang around with, right? So if the news outlets you're listening to are telling you that, hey, listen, we have a strong economy, things are going well, let's just take a couple of months back into March when SVB had their situation and they collapsed, right? Well, what was the premise of their collapse? Their premise was that, A, they bought too many long-term assets at a very low yield, right? Mortgage-backed securities, they bought, the lower interest rates on there, and they bought long-term treasuries at lower yields. And they did that on the premise because the current administration kept telling them, hey, listen, inflation is transitory, which means temporary, that this won't last, things are good. And so they bought into that, and then they had a bank run. And we've described in numerous episodes what that led to. But my point was that executives made decisions based on what the administration was telling them. Now we've got an administration telling people that we have a strong economy. But the way I look at strong economy is, we should be having manufacturing at a better situation than what it is. It's actually below a healthy level, which means we're producing less. Right. So we have limited amount of products being produced. So of course those are going to be inflated. And we also have a savings rate in America right now. As I pull up a chart, if you want to take a look at this chart, because I can talk about it, but a picture's worth 1,000 words. I would definitely go to our YouTube channel and take a look at this on there, because my producer Charlie's going to stick it in there like he always does with these graphs and puts all the good information. But this is astonishing. So when you take a look at the timeline on this, I went all the way back to 1959. I just pulled it from the Federal Reserve, as long as they've been measuring this. And when we get in here, when I take a look at 2020, that savings rate was at an all-time high. Well, I think there's a lot of reasons why it could have been at an all-time high. It was at 33.8%. Like, that's pretty impressive, right? And the second closest one was in the 70s at like 17%. So effectively double, right? That was because, A, the money that was coming in from COVID relief packages. We had numerous rollouts of that, right? But more importantly to that, there was nowhere to spend your money. Like, you weren't going on vacation. Lots of states opened up at different levels. And so the spending habits started to basically go in different levels based on what your state was allowing, as far as restaurants being open and vacations and et cetera, et cetera, et cetera. There was online retail, but it was only accounting for so much. So we went from a 33.8 savings rate to just about a year later down to 26.3. And then we look at a next year later, we're at 3.5. 3.5 came in last week. 3.5. So from 33.8 to 3.5, that's pretty dramatic. Like, some would say that's like a cliff, right? It fell off and it's not good. And so the reason I say that's not good is because that right there, that metric tells me that, A, not only are Americans debt financing their life, but they're dipping in their savings to make the payments they have to make. And I'm going to argue here that I don't think Americans are just buying an abundant amount of stuff. I don't think they're buying a bunch of retail and a bunch of excessive items. I think the damn items are a heck of a lot more than they used to be, and they're probably buying less but spending more. And that's inflation, right? But a lot of that also is because of the manufacturers that I'm talking about. We have less manufacturing now than we did, 2 years ago, right? Well, before COVID, let's back up, because COVID, obviously there was less manufacturing, but before COVID. And we haven't restored back to those same levels that we were at prior to that. And so we're paying more for less items, and we're doing that out of our savings rate. Now, we've all heard that you should save for a rainy day, right? Saving for a rainy day is something that many people say just to kind of remind you, hey, listen, when the dark days are ahead, you want to be glad that you had a savings account, nest egg over here to help make up for that. And, those could be anything: loss of job, bad economy, inflation. The list goes on and on and on. But what happens is, to me, I think that when things are going well and you have an abundance of something, you're saving it. Kind of like what you did in 2020 on this chart, what people were doing. You had a surplus, therefore you're saving and putting that surplus away. When you don't have a surplus, you're dipping into your savings, which means things probably aren't good. And to me, when I look at this is another data set that shows me that the economy is not strong. It's not as good as the current administration wants to tell me that it is. And when I see a Federal Reserve policy that's tied to inflation, and I honestly believe that the government is undermining everything the Federal Reserve is trying to do. You've got the Federal Reserve raising interest rates to do what? battle inflation. They're raising interest rates, short-term interest rate to battle inflation. And the whole concept is to tighten the system to where you, the consumer, don't want to spend any more money. You would rather save it because the prices of the items have gotten so much that it doesn't even make sense to buy it. But in the meantime, the whole concept is to stop the circulation of money. In the meantime, you've got the federal government operating at a deficit, right? So what are they doing? They're creating more money in the system. That undermines everything the Federal Reserve is trying to do by raising interest rates. And they're continuing to do that. And so I think until that stops and some other real hard topics get tackled over there, we could potentially see a counterproductive policy from the Federal Reserve on the raising of these interest rates. And that's something that we've talked about in our lending update. And it's something that we've talked about constantly on this show that could represent an issue. But the reason I wanted to bring this up today regarding credit card debt, regarding the savings rate, and regarding the student loan debt is that, if you're operating in a household and your mindset is, hey, listen, things are going to get better. Things are getting better because the news, social media tells you it's going to get better. Maybe look at the other side of that coin and operate on, hey, what if they stay where they are now? And are we in a position where we can make that work, or are we in a position where we need to pivot and readjust? And do we need to maybe look at some things to do differently to account for what's going on right now? And I just want to share that with you because oftentimes that's overlooked in these situations, and I don't want that to be our audience. So as I bring this up here, last episode we talked about how to save 80% by cutting off and maybe not using a DoorDash service, Uber Eats, or Grubhub, et cetera. There are areas in which we can explore to help kind of curtail some of those spending rates and still do some of the things you're doing on there. So I hope you guys like some of these items that we're bringing to the table here and sharing. Next episode, we'll be back with the lending update, tackle a lot of things in housing and tackle the big rate question on there that I know we keep discussing. And then by that time, we'll also have the Federal Reserve's FOMC meeting that we'll be able to tackle as well later on in the week. So, guys, appreciate everything. 100 episodes right around the corner. I can't say enough thanks to all the people that have helped make this show happen. Streamline Media, Charlie Walker, Daniel Halverson, Alex Stewart, big help. Shout out to all you guys and our wonderful guests as well for spending time on this show and bringing a lot of knowledge about growth and leadership to the table here. So, guys, till next time, check us out on our socials at What's Your One More, and also follow us on Apple, Spotify, Google, Amazon. That's a lot to say at one time, and on our YouTube channel. But thanks again, guys. Till next time, see you. What's your one more?
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.